Hey traders, Raghee here, and in tonight's free video, we're going to talk about some markets that have been very important to how I've been looking for the kind of trades that I'm going to set up and take. And oftentimes that conversation starts off with what I call the 4extra, what I endearingly call 4extra futures. And that's because there are a handful of futures markets that have application to Forex trading. Now, I don't even want to say Forex trading as much as I want to say currency trading, because the Forex is where spot trades are executed. But to trade currencies, you could trade currencies through futures, through options on futures, through ETFs, the currency share ETFs, as well as the spot market. So if we're talking overall this notion of currency trading through a particular avenue, meaning Forex, that's fine, but this applies to all types of currency trading. In order to understand what could happen in specific currencies like the dollar, I'm going to want to look at the dollar index. I'm also going to want to look at Euro US futures or the Euro US spot, the Forex. If I'm going to want to understand what's happening in the yen, I could look at the yen through a number of relationships. Aussie yen, perhaps to take advantage of the carry, or dollar yen to take advantage of the US dollar and the Japanese yen. So we have to understand where the conversation comes from. Now, the point of tonight's video is this. Lately, the conversation for me has been coming from the risk appetite that we've seen in the equities markets. Now, it's not just the Dow, and in fact, if you're looking at the Dow and saying, well, Raghee, what about the S&P? That's fine. They have about an 80+% correlation. I just prefer to watch the Dow. I think it's actually more predictable in the way that it moves from major to minor psychological levels. And I think once it gets trending, because you're only looking at a group of 30 stocks, 10 of which account for over 50% of the weighting, versus the S&P with 500 stocks, where the top 10, I think, account for less than 20%. It's a little easier to see that once, say, the Dow gets going, it really gets going. It doesn't take as many stocks to move the index in one direction or the other. But it is because of the strength in the Dow and also the transition out of the downtrend in the Nikkei that I have been playing more risk appetite, more risk on type trades. What does that mean? I've been looking for opportunities to sell yen, Aussie yen, Canadian dollar, Japanese yen. I've been looking for opportunities to play Australian dollar strength, whether that be against the pound, one of my favorite ways of doing it. Same thing with Canadian dollar strength, again, against the pound. So why would I want to buy ComDolls? They benefit from risk appetite. Why would I want to sell yen? The yen weakens in risk appetite. So what I also want to be aware of is when that risk appetite could stop, stall, correct. So when I look at the Nikkei, I remember that the yen has to serve two masters. The risk environment kind of has this first look of the day from Asia, and the Nikkei is a great way to look at it. You could look at Nikkei futures. You could also look at the EWJ ETF. I prefer Nikkei futures. This is going to dictate what I think is going to happen to the yen and some of the ComDolls during the Asian session. That's going to continue on till about 2 a.m. Eastern, when Europe gets into the picture, 3 a.m. Eastern when the UK gets into the picture, and then 4 a.m. Eastern when the Asian session closes, when the Asian markets close. And then I start to think about what is going to happen with the Dow. And the Dow, the S&P, pick the particular index that you want. Doesn't matter to me. They're highly correlated. They move very similarly. I just happen to like the Dow. So from the Nikkei, I then go to the Dow and I think about, okay, now what is the risk environment? What are the ComDolls going to do? What are the yen going to do? If the Nikkei and the Dow are on opposite ends of their movement, and for a while there was a push-pull, the Nikkei's just now transitioned out of the downtrend. Doesn't mean it's in an uptrend, and I do believe around the 17,250 area, even around 17,1, we could start becoming overbought on the Nikkei, and therefore the yen may not be as weak during the Asian session. And when the market starts to consider what the yen was doing in the Asian session and looks from the perspective of the U.S. markets opening, and they look back at the yen being maybe flat to strong, that does diminish risk appetite a little bit. It does affect it. So then I look at the Dow and I say to myself, well, this Dow could exhaust between 17.5 and 17.6. I'm not looking for the Nikkei to take out the recent sideways lows. I'm not really even looking for the Dow to do much more than perhaps correct to about 17.3, but I want to be ready for that potential correction. And then on top of that, I want to get opportunistic, which means that on the pullback, I look for ways to re-engage yen shorts, to re-engage Aussie buys, Canadian dollar buys, because the near-term momentum is going to be a 180 of every one of those positions. And let me show you what happens when traders fall in love with a position and don't acknowledge when a market's corrected. You get the short squeeze on the dollar. You get the short squeeze that we see on the euro US dollar, and you can call it a long squeeze in the dollar index. Traders went into the weekend, many of them, short euro, long dollars, without acknowledging the 112 to 111.50 support level, and then got a big surprise today. And you can look at that on the flip side. So this is what happens when we don't prepare for corrections and when we don't acknowledge what those corrective levels are. And I'll have more on that topic throughout the week. Hope you enjoyed the video. I'll see you in the next update.